Good morning, everyone. My name is 𝗂𝗶𝗱𝗶𝗴𝗍, and I'm a senior consultant with Agusto Consulting Limited. We welcome you to our webinar where we'll be discussing the impact of the Middle East crisis on the Nigerian economy. We are delighted to have you join us this morning, and we look forward to an engaging discussion over the next 1 hour. Our chat room is open. Please share your comments and your thoughts. We'd like to hear from you. We would also have a room provided for question and answer, and we'll try to take as many questions as possible during this session. We'll also be conducting a number of live polls to get your opinions and your perspectives. Our first poll should be coming up right about now. It should pop up on your screen. Okay, thank you very much. Would really like to hear your opinion and see your perspectives to how the Middle East crisis would affect our economy here in Nigeria. Thank you. Thank you very much. I see so much participation already. Okay, thank you. Thank you. We'll just give a minute to have as many participation as possible. Thank you very much. Very well. If you're just joining us, good morning and welcome to Agusto Consulting's webinar. We'll be discussing the impact of the Middle East crisis on Nigeria's economy. Right now, in a few seconds, we'll be ending our first poll. We just want to get your opinion and your perspectives on the subject matter for today. Thank you. Good. Thank you very much. Thank you. The level of participation is very encouraging. Thank you very much. Thank you. Just 30 seconds more. Okay. Good morning if you're just joining us. You're welcome. 10 seconds to go. Thank you. All right. Thank you very much. Moving on to take us through this very insightful session this morning, please join me in welcoming the head of Agusto Consulting Limited, 𝗘𝗀𝗁𝗍 𝗂𝗶𝗱𝗶𝗱𝗍. Thank you.
Good day, everyone. Would like to thank you all for attending this webinar. We really do appreciate the attendance and the time you've chosen to spend with us. Thank you, 𝗂𝗶𝗱𝗶𝗍, for the introductions. I would like to start with two very warm conversations. In the course of preparing for this webinar, after we had pushed out the invitations, we got two interesting questions. One came just a few moments ago. But the first of the questions is this. Someone shared with me an update on the crisis and said, "Are you sure you wouldn't be updating your slides every second?" And I had a good laugh about it. And then, just as we were preparing, having live session simulations, a colleague rushed into my office and said, "Jimmy, have you captured the recent updates around the Strait of Hormuz?" And we said to him, "We're not capturing anymore. We've captured enough." So it's possible that as we're here in this webinar, there may be live updates that render some of our conversations obsolete and out of date. It's where we are today, where we found ourselves in the world. At Agusto Consulting, we often say this. It's a cliche that we thought was already becoming overused. We say volatility is the new normal, but even then sounded quite stale because we're seeing geopolitics move at the pace of stock prices. So at the time we thought volatility was the new normal, we're a bit too forward because now volatilities are the change of movement of a stock price. So how do we find some level of steadiness in all of these? That's what we're here to discuss. Thank you very much once again for joining us. Today, we'll be looking at 4 basic outlines: the background and the concept of the Middle East crisis. We'll be looking at the oil markets because that's one way it materially affects the world. We'll also be looking at Nigeria, the implications of this crisis on the Nigerian economy. And then finally, we'll be preferring some thoughts together. And that's why the polls are quite important for you to participate in them. What can Nigeria do to hedge against all of these risks? I think it would be nice to go into some background and context of the Middle East crisis. We know the news, there's 24/7 news, which you get a lot of all of these news on, and many of us are awash with all of these news, but we just thought it would be good to start with a quick update and a quick background. How we got here, at least this present crisis. On February 28th, 2026, the US and Israel launched joint strikes on Iran. This was scaled up vis-a-vis prior attacks in the past. 3 target locations were hit within 30 seconds. In retaliation, Iran closed the Strait of Hormuz and we witnessed a global energy shock. So where are we today in terms of status? And like I warned, everything I'm about to say in terms of status may go still by the end of this session. A ceasefire was announced on April 7th, 2026, brokered by Pakistan. There was a 2-week truce which expired on Wednesday, 22nd of April, which has now been renewed. Both sides, there were incidents that you could describe and define as violation of the ceasefire immediately after its declaration. Peace talks have held in Islamabad, the capital, in Pakistan, between 12th and 13th of April, after 21 hours of the first negotiations, which was led on the US part by the US Vice President. No agreement was reached about Iran's nuclear uranium enrichment program, which is the sticky point in all of this. Uranium is a key commodity for the production of nuclear, whether nuclear weapons or nuclear for electricity and nuclear for other things. And it's quite interesting that Nigeria's neighbor, Niger Republic, has one of the richest deposits of uranium. And if you follow geopolitics, if you go a bit more into history, you would see that when the ground rhetoric was being laid for the war in Iraq by President Bush, there was a link to Niger Republic. So in sum, it was a conflict timeline. Let's take it back to October 2023, when Hamas attacked Israel, over 1,200 killed, 253 taken hostage. We'll show you why this is important as well. In April 24, Iran launched missile attacks on Israel's territory. In late 24, Hezbollah leadership was decimated by Israel. Assad regime, we'll show you why Assad regime also comes in here in Syria. And then Iran lost a key land corridor and a key ally in President Assad and in Syria. And then in June 25, there was a 12-day war. Israel strikes Iran's nuclear facilities. US also joined the bombing, bombed Fordo, bombed Natanz, and bombed Isfahan. And then in February 26, US and Israel strike eliminated the supreme leader of Iran, Khamenei, which was an escalation, an unprecedented escalation. Iran retaliated by closing Hormuz, and then we saw the global energy crisis erupted. In April 2026, what have we seen? It's been the month of ceasefires, the month of blockades. There's been the 2-week version of the ceasefire, the extension, and what we've put in italics as the indefinite extension of the ceasefire. Why is Iran so important, really, in all of these conversations? Why is Iran so important? Sorry, 1 second. I think I may have lost my screen in error. Okay. 1 second. Okay. Why is Iran so important, really, in all of these conversations? Iran has a strategic position in the Middle East, and you would see that it's even stretching beyond the Middle East. And what's this strategic position? Iran has it controls what is known as the axis of resistance. It exerts its influence across the Middle East and beyond using a network of state and non-state proxies in Gaza, Palestine, Lebanon, the Hezbollah movement, Syria, the Assad regime, which has now lost. That was a critical land corridor supply route as well. The Iraqis allied the Shia militia in Iraq, which operates across Iraq. Yemeni, the Houthis, quite an important ally to Iran, because if they even get to lose the Strait of Hormuz, the Yemenis are there to help them distort the Red Sea. And then as far as Africa, so this even goes beyond the Middle East. It goes beyond the Middle East. Iran also is supporting the Sudan Armed Forces, which has an ongoing civil war with the RSF, the Rapid Support Forces, which means that Iran's influence has extended to Africa. So that's it on the geopolitical influence of Iran. Let's look at what Iran controls in terms of crude oil productions. Iran controls around 3 million barrels per day. It can produce up to 3 million barrels per day, which is very important in the world because that's about 3 to 4.5% of the world's global oil supply. So that's very important. And you also seen that after the Strait of Hormuz was closed down, we'll talk a bit about what that means for oil prices subsequently. Interestingly, we've seen a material increase in Iran's crude oil production over the years from around 1.9 million, below 2 million barrels per day, which a country like Nigeria would do anything to attain. In July 2020, Iran is today, nearly double of that at 3.2 million barrels per day. And there has been a slight uptick over the last 2 years. Now let's talk about the Strait of Hormuz we've all been hearing about. Why is the Strait of Hormuz important? Just where this red circle is. The Strait of Hormuz is very important because it's this little corridor that 20 million barrels of crude oil passes through. 20% of crude consumption goes through the Strait of Hormuz. 19% of LNG globally goes through the Strait of Hormuz. The Gulf alone accounts for about a third of all seaborne fertilizer exports and 46% of urea, which is the world's most widely used nitrogen fertilizer. That matters for food security. 1/3 of the world's helium supply passes through the strait. Helium is needed in semiconductor processing, MRI scanners, and constraints are already affecting those critical machines. You could have bypasses in terms of pipelines for crude oil and even gas. But what about fertilizer? Would you have pipelines for fertilizer? No. On average, 138 ships pass through the straits daily. From the start of the conflicts on February 28th to March 7th, only one single commercial vessel passed. Just one. From 138 to 1. So what do you have then? You have manufactured and finished goods blocked from entering the strait. This is very important for world trade, world stability, and the global economy. In normal times, what does the strait look like? 30,000 vessels pass through the strait each year, which comes down to about 138 vessels per year. Of these daily transits, around 60 to 70% are oil tankers and gas carriers. Since the strait, we've already said there's been a 95% collapse in these shipments. In oil cargo tonnage, you have about 11 million barrels per day that can pass through the strait. You don't have all of that anymore. Now, you can have pipelines for all of this, but what about fertilizer tonnage, which really matters when we bring this home to Nigeria? There's no available pipeline workaround for fertilizer. Nearly 1 million metric tons of fertilizer cargo are physically stranded today in the Gulf. Vessels from the Persian Gulf to destination ports take about 30 days. Disrupted supplies, and you need to hear this, disrupted supplies will miss March and April, which are the peak planting seasons. So March and April, which are peak planting seasons, if these shipments miss that timeline, then you could already have some food issues on our hands in the world today. So what's going on in the streets today? We hear a lot about what's been happening. I'm even afraid to share these updates with you because they could just change by the end of this conversation. But I think there's one important point we need to highlight in all of these. There's been a lot of emphasis on all of the fightings and blockades and counter blockades and seizures of boats and ships along the strait, and how China has been able to find its way and also suffering some impact. But I think what we need to recognize is this, is the insurance risks. In shipping and in maritime, you do not send a vessel on the seas without insurance premiums. You do not. War risk premiums surged to 60 times pre-crisis rates within 48 hours. And that's from the Lloyd's Joint War Committee. It's designated the entire Arabian Gulf as a conflict zone, making standard commercial insurance effectively unavailable. So amidst all of these wars, keep your eyes on the insurance radar. Where the insurance space is saying we can't even insure vessels in this Arabian Gulf conflict zone today. On the other end, you haven't got insurance on you because the insurer has pulled back. And then Iran has formalized a $2 million per vessel toll via the Larak Island, payable in yuan or cryptocurrency, turning the world's most critical energy choke points into a geopolitical revenue stream. So let's bring this into the oil markets and look at numbers around this, current market developments and numbers as well. Oil supply has dropped by around 10 million barrels per day. This has had significant impact on supply. Demand, so more of supply, which is why you're seeing price increases, and projected to fall further to 94.2 million barrels by the end of April. While global oil demand is experiencing some reduction somewhat, it remains above supply, thus fueling further risk of price hikes in oil products. We're using the Brent today as our benchmark, not even the Bonny Light and such, and not the WTI, because over 70% of benchmarks and trades are done around the Brent. So the Brent has remained incredibly sensitive, surged above 5% to above $95 per barrel on renewed tensions after President Trump confirmed the US fired and seized an Iranian cargo vessel. 5% on the oil markets is a big deal. And let's put this in context. At the start of the year, one of the biggest global banks, JP Morgan, had a forecast for the Brent averaging $60 per barrel for 2026. We've touched double of that for this year. So the forecast is now immediately irrelevant, showing is irrelevant on one extent, and also relevant because it shows us how completely the Middle East conflict has overturned market assumptions. So imagine going into the year with $60 per barrel, and we're hitting 95, hitting over 100, hitting 120. So let's look at what year-end prices have been. Let's bring this into context. In 2019, the year-end price was just around $70. COVID year, average price of around $50 per barrel. End of last year, we ended the year with around 63.4. And year to date, we're already doing around 100. So if you look at where we are today between where we were at the depth in COVID, we're already double. $50 per barrel, additional $50 per barrel in 5 to 6 years is quite a big deal. And it could trigger a lot of crisis in households, in businesses, and in national economies. So we've just put out some timelines to you, just showing how all of these have played out, how the crisis affected Russia-Ukraine war took. So we're seeing price rises that are mirroring the record highs of the Russian-Ukraine war that took prices above $130 per barrel. Now, what we've also done here is to look at a shorter time frame. From the beginning of the war to date, what has happened? So from the beginning of the war, we had Brent around $72 per barrel, 26th February. And then where are we? by April, March, end of March, April, we're already at $129 per barrel within the short time frame. It takes a lot to move oil prices so high within this 60-day time frame. We're also looking at, we have to keep our eyes on Bonny Light because that's Nigeria's. And so Brent, now, two things you need to take away from here. Bonny Light is what matters to Nigeria because that's what we produce. And it's called light because it's easier to refine. So it's a sweet crude and it attracts a premium to Brent. But typically, the Bonny Light premium on Brent is typically within a range of $1 to $3. And if you see the timelines of this chart from February 26, end of February 26, all the way to around March, mid-March, you would see that it maintained that $1 to $3 premium between. So Bonny Light will typically trade above Brent. But what has happened? Look at where we are today, 129 to 90.4. So over $30 premium between the Bonny Light and Brent, unprecedented premiums as well. So these, when we send you the materials, you can read up on all of these, where we're just showing you how oil prices have been reacting more to the news than even the actual incidents. So oil prices today react more to news. The announcement effect on oil prices has become quite elaborate and, maybe quite exaggerated, actually. Let's begin to bring this home. Implications of the crisis on the Nigerian economy. The first key, and maybe we should start with some broad introductions of what's happening with Nigeria around fuel prices, domestic fuel prices. And maybe we'll start with PMS. Nigeria is an oil-producing country. In Agusto, we like to say Nigeria is not an oil-rich country. We're an oil-poor country. That's what we say in Agusto Consulting. Nigeria is an oil-poor country. And it's one of the important things I want you to take away from here. Why do we say Nigeria is an oil-poor country, even though the rest of the country says Nigeria is an oil-rich country? Nigeria has a production capacity which is different from actual production. So take note of that as well. We've got a production capacity that can go as high as 2 million barrels per day. We've got a population of 200 to 220 million people. You're not oil rich when 2 million barrels per day is what 220 million people produce. That's not an oil rich country. An oil rich country is more like 4 million barrels per day for a population of 4 million people. So when Nigeria loves to compare, and Nigerians love to compare, when we love to compare the qualitatives of being oil rich with the, in quote, the real rich Middle East countries, where you've got countries producing 10 to 12 million barrels on a population of 40 to 50 million people, is because we've taken our eyes off the numbers. We've got to keep our eyes on the numbers. And what do the numbers say? The numbers say that we're an oil poor country. So if we work on the basis of that premise that Nigeria is an oil poor country, it means that when Nigerians then demand for subsidy, what was subsidy? Subsidy was simply how the government tried to provide some pricing sweeteners and pricing cushions to reduce or manage the price of petrol for the end user. So this is an oil poor country where citizens would typically want oil prices to mirror that of the oil rich countries. So the government then took away the subsidy, and there have been several attempts by the government from the 80s. The military dictatorships tried. On the outset of the Fourth Republic, we tried, and finally we've done it. Subsidy is gone. The statement on May 29, 2023. So the subsidy was removed, which means that the PMS prices, which is the petroleum, the petrol prices at the fuel stations in Nigeria, would start to mirror that of global oil prices because there's no price cushion anymore by the government. In other words, when prices go up globally, when oil prices go up globally, then petrol prices in the pump stations will also go up in Nigeria because the government has taken away that price cushion that was helping to moderate prices because Nigeria couldn't afford it because we're an oil poor country. So in January 2025, you can see that we're trading, average PMS price was around 1,200 towards 1,300. And then as oil prices started to moderate, we started enjoying the market realities of price movements, of demand and supply actions on price movements. So prices went below 1,000 by September 2025 and kept going lower. However, as this crisis then started, we're inching backwards to what we had around January 2025 of over 1,200. We've now crossed the January 25 by April 1,260, which is the average price. So prices were driven by the combined impact of subsidy removal on one end and the higher cost of imports. By September, prices had settled. If you remember September last year, prices had even gone down to as low as 500 to 600 per litre. As geopolitical tensions escalated, fuel prices rose above 100% to 1,200 in March. And despite high global prices, Nigeria recorded a cumulative shortfall of about 80 million barrels over the past year. Now, that's another pressure point for Nigeria, which we'll also get to discuss. Diesel, on the other end, isn't subsidized. It's market-driven. It's always been market-driven for, since the Obasanjo second term. So we've also seen what has happened to diesel. From 750 around 2024, the lows of 750 were able to secure diesel around the 980. From September 25 to January, we're able to secure diesels around the 980 to 1,150 range, and we're able to trade diesel at that range. But what have we seen as well? We've seen diesel, jump materially to 1,600. Why is this also very important? Why is the pricing of diesel very important in Nigeria? I would also get to discuss that. Private power generation costs for manufacturers and businesses. Nigeria is heavily dependent on diesel or private power generation for manufacturers, businesses, and even homes. Maybe HNI homes, high net worth individual homes too. Because the national grid, we have a national grid that can't offset, that can't really take away diesel, really. It's incapacitated. And at the same time, what have we seen? You also remember that transport haulage is largely by diesel, even though we recognize the efforts to transition to CNG. Now, using the price of moving a container as a proxy from Apapa Port to Ikeja, it's risen from 450,000 to nearly 700,000, a 56% spike as a result of this Middle East crisis. So this starts to show you the impact of this crisis on businesses, on households, on consumers in this country. This 56% spike, which businesses incur in the cost of moving container and the cost of haulage, will largely be passed on to consumers via the landed price of goods. Let's also look at what FAC allocations have looked like to really test how much Nigeria has benefited from the Bonny Light oil pricing. The blue chart is FAC allocation, the red chart is Bonny Light pricing. Some interesting trends here. You would see that around 2020, if you look at the chart from 2019 to around 2020, all the way to 2023, March, May 2023, you would see the strong correlation. What we did here, just to explain what we've done here, is we've taken the data on FAC and we've taken the data on Bonny Light oil prices and we've rebased it to 100. We've rebased both factors to 100, starting from January 2019. And you would start to see the divergence between FAC and oil prices around January 2024. And you ask yourself why. You can see that the FAC index is getting elevated above even the oil price index. Why? Because Nigeria started increasing reliance on non-oil taxes. I'm sure you've all heard about the tax reforms. A few of you, like I have, your tax bill is much bigger than it has ever been. okay, not because your income increased materially, but because the tax reforms have taken effect. And you see that all the way to February 2026, which is the last data we've tracked. So Nigeria is increasing dependence on non-oil taxes. And while on one hand, we can enjoy the benefits of oil price increases, because of our poor production data, and we'll show you the budget number subsequently. We've got a budget that is premeditated, that is hinged on a 1.84 million barrels per day, and will stubbornly stock at below 1.5 million barrels per day. So it means that for businesses and households, as long as our production numbers do not materialize into the increases that we typically budget for, the government will continue to rely more on you and I, which means non-oil taxes for its earnings. What about the exchange rate? The important thing that you need to take away around the exchange rate numbers is this. What's more important for Nigeria than anything is stability, price stability, even above the proverbial one-to-one that our folks always, wouldn't let us be about. What's important really is price stability in the exchange rate. And even amidst this crisis, Nigeria has been able to achieve price stability of below $1,400, and which is what our forecast also are hinged on, that we will be able to maintain around this 1,400 naira level to a dollar. What about inflation? You can see that after we rebased inflation, and you can go back to our materials on the rebasing of inflation, which we did have last year. You can check our social media handles for that to just educate yourself about rebasing. So we had 34 points, around 35% in inflation at the end of last year. And then we did rebase, 2024, we did rebase, and then we were able to bring the inflation downwards now, base effects, all of that to around 15%. But when we discuss the inflation forecast, we will see that there are significant risks to these inflation numbers, because core inflation, food inflation, will share the risk around those two with you. I think one of the things that has also helped Nigeria through this crisis is how we've managed interest rates, key interest rates, especially the 91-day benchmark. What was happening here around the 2020, basically the 8 lost years of the last regime, is that we were witnessing negative real returns. And what do we mean by negative real returns? We mean that, so if you look at what inflation was here, inflation was above 20% all the way to 35%. But you can see interest rates were largely below 10%. It meant that you lost holding on the naira because inflation was higher on the naira than the real returns, than the returns you earned on the naira, which meant that your real returns were weaker. And that's why we did see a lot of speculation in the dollar, on the naira, the run on the naira from households, from businesses, and from speculators, basically. So now that we've been able to manage inflation and have a small positive real return of just around 1 to 2%, it's helped the stability of the currency. And we've also got to keep eyes on this. This is one major indicator we have to keep eyes on. That difference between inflation and interest rates, because that would determine the level of faith investors have in holding the naira, especially because we see inflationary risks in the horizon. Now, one of the issues that we have to be really worried about, that should keep us awake at night in this country, is around fertilizer. It's one of the big issues. We'll discuss it more when we summarize all of these. Fertilizer prices have experienced a massive surge as a result of all that's going on. Urea prices have risen nearly 40% since February 26 to $720, driven by rising energy and feedstock costs, supply constraints. We told you earlier that you had millions of tonnage being held in the Middle East. The closure of the Strait of Hormuz. Remember that Russia, Ukraine collectively account for about a quarter of the world's wheat. Russia also accounts for over, on a good day, could account for over 15 to 20% of world's fertilizer production. You've got constraints in that area. And now the second belt for fertilizer in the world is in the Middle East. The Strait of Hormuz, 30% of globally traded fertilizer passes through the strait. It's responsible for critical inputs like ammonia, urea, phosphorus from key producers like Iran and other Gulf nations. So we're afraid that we'll have limited supply ahead of the crucial planting season. Here in Nigeria, smallholder farmers operate on thin margins. They're the most affected by these rising input costs. Many are at risk of being unable to afford fertilizer prices, with worsened food security, and we'll talk about that. So let's summarize the key downside risks for Nigeria. The first is energy prices. Petrol prices are up about 60%. Diesel prices are up about 65%. And this is where it really hits us the most. Electricity supply over the last 4 months in Nigeria is, by Nigerian standards, and I say this with a bit of shame, actually. By Nigerian standards, electricity supply, by global standards, Nigeria's electricity supply is a cause of national sobriety. But even by the very low standards, by the very low Nigerian standards in terms of expectations around electricity supply, I think what we've experienced in the last 3 to 4 months is a low on a low. It's a low on a low. So when petrol prices go up and diesel prices go up amidst a downturn in electricity supplies, it's, should I call it a double whammy now or a triple whammy? So as more households and businesses depend on self-generated alternative supplies for electricity, it's going to have a disinflationary impact, and we're projecting somewhere between 18 to 20% at the year end. The surge in petrol prices and diesel prices have also had a direct impact on transport and logistics. Interstate fares, which we're using as a proxy here, have surged depending on the route between 40 to 70%. Transport and logistics operators will mainly pass these higher input costs to consumers where they can. But remember, if you follow the news, you hear what the aviation sector, what they did push out a few days ago, that they were grounding airplanes because they were struggling with passing on these higher costs to consumers. So they said, you know, we're going to ground airplanes. And the federal government stepped in with some sentimental push that, oh, please don't, let's keep this economy floating and all of that. But the more, how much more can they hold on before they pass on these higher costs to consumers? So expect higher prices if all of these persists. Now, the United Nations UNCTAD says that when oil prices go up, food prices often go up. UNCTAD also says that when gas prices go up, fertilizer prices often go up. When we bring this home, what happens when there's insecurity in your farming belt as a country? What happens to food prices? So this is a triple whammy for Nigeria, or maybe a quadruple whammy. Oil prices are up, gas prices are up, and of course, when these two go up, transport and logistics prices also go up, and we shared the data with you on that. And if I were to ask a question, has the insecurity reduced in the farming belt? I dare say no. So Nigeria is facing a quadruple whammy around food security. So on one end, we're a net exporter of fertilizer, but market imbalances remain. So Nigeria exports fertilizers today, which is a very good narrative for our story. However, on the local end, something happens. The state government, the subnationals like to intervene in the fertilizer market, and they say to the farmers, the smallholder farmers especially, that will provide you fertilizer at subsidized prices. But you know what always happens in Nigeria when the word subsidy comes in? It means that there's a distortion in supplies and we're not able to meet supplies. So we need to keep our eyes on this because the food insecurity could stoke social risk, especially if we do not take care of this fundamental issue, which is the farming, the insecurity in the farming belt. Interestingly, what are the bright spots? The bright spots just flip, or in some cases, just touch the same dark spots, really. Oil prices. When we had a budget this year of some $5 per barrel, for crude. Our budget this year till $5 per barrel. Oil prices are hovering over $90 per barrel, all the way to 100 plus. And we showed you what the money prices were. So Nigeria is experiencing a pricing upside. However, with production levels of 1.5 million barrels per day, when the budget benchmark is 1.84 million barrels per day, cap the country's windfall capacity. So our ability to enjoy a windfall, we like to use that word windfall around oil revenues in times like this. But let's remember this time around that production is weaker, and it's a simple equation: is price times quantity, which gives you revenues. So the price is higher, but the quantity is weaker. So it's going to cap what your overall revenues will be at the end of the day. In terms of industrial real estate, and that's a very interesting view, which in the course of preparing for this webinar, we got that from the Middle East as well. It was shared with us with a client of Agusto, saying that in the Middle East today, the geopolitical tensions had blurred the attractiveness of the Middle East as an industrial hub due to the distortions around key shipping routes. So there's been a surge in industrial clusters, especially around the Lekki area, in which integrate the deep sea port services with economic processing zones. So that integration that we've been able to achieve as a country by private sector led investments and PPP efforts increases the attractiveness of our country, of Nigeria today, to attract industrial real estate projects, to attract manufacturing concerns into this country amidst all of these crises. So we've identified that as a bright spot. Fertilizer as well. We currently produce to export as a country, which is a major boost for us as a country. Fertilizer in Nigeria today, last year we end over $1 billion. No, sorry, 2024 we end over $1 billion, and last year that number could surge to as high as $1.2 billion. We're 19th in the world in fertilizer, making it the second largest non-oil export outside cocoa. So, in closing and rounding up, what can we do as a country to hedge amidst all of these risks we've identified? We'll look at two policy reviews we have to think about as a country, and then we'll look at two structural issues as well. The first, I'm not sure why it's controversial. It's controversial because we have statist economic policies in the DNA of the average Nigerian. Nigeria today has become a net exporter of refined petrol. But we're saying this, and we'll be shocked if it becomes controversial. It shouldn't be. What Agusto Consulting is saying is that we should liberalize fuel supply, even though we've become a net exporter of refined petroleum. Why? Because in protecting producers, we also need to say, how do we protect consumers? And we need not make the mistakes and the errors we've made in other commodities, especially in cement. So amidst Nigeria's new refining capabilities, we must still liberalize fuel supply to allow refiners come in, to allow importers come in, because we need to protect the consumers. So we need to stimulate competition in the fuel markets through local production and through imports. The pricing regime in the local fertilizer markets, we also have to review that. We've become a net exporter, but like we said, the fertilizer subsidy interventions of subnationals, we need to ask ourselves this rhetorical question: is it working? Why do we have supply shortages at critical points in time during the farming season? We need to review the market pricing structure in the local fertilizer markets. It's not a federal government-led subsidy program, but it's one that individual states put in place. But we've got to ask ourselves this tough question: is it working? Somehow, somehow, as a country, we've tried to adjust with life without grid electricity. It would only take us thus far. Only take us thus far. We've been stubbornly stuck below 5,000 megawatts in a country of over 200 million people over the last 2 decades. Even with installed capacity of over 13,000 megawatts, which is also very low. Nigeria should be aiming for 50,000 megawatts. So we're at 5,000 today, and we're saying we should be aiming for 50,000. We need to grow that by 10 times. As a country, we need to fix this. Energy alternatives, especially renewables, also becomes a non-negotiable. We need to put in the right policy framework to stimulate the penetration of renewables. It's a stopgap and is also a permanent solution. Renewables off-grid, renewables on-grid. I think the brightest spot in all of this is the NLNG Train 7. I think it's the biggest news I'll be leaving you with. With the Middle East crisis, more countries are seeking out new supply sources for gas. NLNG Train 7 should be due in the next 12 months, quite imperative for Nigeria's global gas play. It would boost Nigeria's current gas capacity production today by about 35%, taking our production from 22 million tons per annum to around 30 million tons per annum, adding about 8 million tons per annum. And why not? We should also be thinking right now of NLNG Train 8. Thank you very much, everyone. Thank you for joining us. I'll be taking a pause here for your questions and answers. 𝗚𝗺𝗽𝗀.
Thank you very much, Jimmy, for the insightful session. I'm sure our participants have taken one or two lessons from what you have shared with us. We're taking our second poll very quickly. Would encourage us to participate, after which we pick some of the questions that we have. We have some questions in our question and answer chat, but let's very quickly, respond to the second poll. Thank you. Okay. This is very interesting. Okay. Thank you. How would you characterize the net economic impact of the Middle East crisis on Nigeria over the next 6 to 12 months? What do we think? What's our opinion on that? Okay. 30 seconds more. All right. Okay. 10 seconds. I think I'll just give Chris for an additional 5 seconds, and then we close the poll so that we can see the response of the first poll and of this very poll. Thank you very much. I think we can take down the poll now. Thank you. Please share the results of the first one. Let's see how we did. Okay, our first poll as we commenced this webinar was, what do we consider to be the primary channel through which the Middle East crisis will impact Nigeria's economy? About 66% of us feel that it's the oil price volatility. That's, the Brent and the Bonny Light versus fiscal revenues and fuel pricing. While about 10% of us felt it was the exchange rate pressure. We're going to be pressures on our exchange rate. And while 22% of us feel it's imported inflation, we'll be having inflation from, the importation of certain things, fuel, fertilizers, and all of this will impact on our economy that way. And just 1% feels is financial market risk. Interesting. Thank you very much. Can we have the results of the second poll, please? Okay. How would you characterize the net economic impact of the Middle East crisis on Nigeria over the next 6 to 12 months? I'll start with the largest response. 43% of us feels it's going to be a mixed, impact, a blend of oil gains by inflation, then FX pressures, while 38% of us feel there'll be moderate negative impact on our economy. 11% feels it's going to be very severe, while 9 of us feel there'll be net positive impact. I would like to have more opinion on that. For those 9% that said there'll be net positive impact, feel free to drop more of your comments on our social media platforms. We'd like to, further this conversation. Thank you very much. Let's quickly go to our question and answer room and pick out a few interesting questions for 𝗘𝗀𝗁𝗁. Okay, I would like to take one from Angela Ndugu. She's asking, do we have Brent crude in Africa, and how does it compare in the marketplace? Jimmy, would you like me to run through all the questions after which you take them, or do I take each question and you respond immediately?
I think you can combine questions.
Okay. Then we have a question from 𝗂𝗓𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂𝗂 solely on renewable energy. Do you consider this a net positive or negative for the Nigerian power sector? Then we have Miriam Aminu. She's asking, what is good news around the increased earnings in crude sales for the federal government caused by the Middle East crisis? And what does it mean for the economy's interest rate and inflation?
Okay. Please permit me to just start from the red to the top.
Okay.
So I'll just start with Mariam Aminu's question on what it should mean for us. I'll tell you what it should mean, and I'll tell you what it means, the reality over the the desired. So what it should mean for Nigeria is that we should be able to earn more crude. But like we said earlier, what you earn from crude is dependent on two factors: the price of crude, the production of crude. The price of crude is globally determined by all sorts of global factors, like we're seeing today, that when there are constraints around supply of crude, it drives up the price of crude. But you only book revenues from crude when you sell crude. Nigeria is underproducing on its crude. We could be producing 2 million barrels. Our budget says 1.84 million barrels, but we're stubbornly stuck below the 1.5 million barrel mark, which means that we are not going to earn the kinds of windfall we should earn. Okay, so that's the impact there. The impact as well is that the fiscal buffers that a period like this should lead to. In other words, we should be saying to ourselves today, how do we take our reserves through this crisis from below 50 billion barrels to, say, 55, upwards to 60 billion barrels, which would mark the Obasanjo era records, Obasanjo into Yar'Adua era records of reserves. But because of the production constraints, then we're suffering around that. So I hope that answers Miriam's questions. On the other question around if we should be going off grid, well, the truth is that what's on the grid anyway? 220 million people have to share less than 5,000 megawatts amongst themselves. So there's really nothing on the grid for an energy, a resource, a country like ours that has got telecoms ambitions. We want to drive the internet usage in this country. All of these things require electricity to take care of your mass across the country, your telecoms equipment across the country. Then manufacturing, a lot of serious manufacturers are entirely off-grid, and more homes are getting off-grid. However, as much as Nigerians are going off-grid, it would not take us to our economic El Dorado. It wouldn't take us to economic El Dorado. It wouldn't. What we need to do really is, for a household, I would encourage you to go off-grid, but from an aggregate conversation standpoint, from a country level standpoint, we need electricity on our grid to drive development. This country needs to be posting growth levels of 7 to 7.5% GDP growth for the next 10 years to lift millions out of poverty. We're not going to achieve that with 5,000 megawatts. So we need to bring the seriousness that other countries like Ghana have when they had this crisis, the Dumsor crisis. We need to bring that level of seriousness into this. Where we've concentrated efforts is going off-grid, but I think we have to have that national conversation about boosting grid supply once again. And then in terms of Brent for Africa, different countries have got their own different versions of crude. Algeria has got it, Angola has got it, Nigeria has got it, which is the Bonny Light, and we just discovered another sweet one again. So, Fumi, do we have time for more questions before we?
Okay, I would like us to just take one more question, and we apologize for the questions we can't take. We'll try to reach out to you personally to respond to your questions. Let's just take one from Mr. 𝗜𝗺𝗀𝗃𝗁. Talking about the need for Nigeria to leverage oil windfall from the ongoing Iran and US crisis, I think that there is a need to deeply interrogate the data to determine if there are real windfall for Nigeria in all of this, considering mortgage substantial part of its crude in advance prior to this crisis diverse. What does windfall actually come to say at the end of April for Nigeria?
So I'll just sign out by saying I quite agree with Dr. Wane here, Dr. Vincent Wane. There's no windfall. There's a potential windfall. But like you all do know, nobody goes to an ATM and withdraws potential cash. You go to an ATM and you withdraw cash. Same with Nigeria. Nigeria cannot go to its National Treasury ATM and withdraw potential windfalls. We can only withdraw windfalls. So I do agree with Dr. Wane. We have to begin that transition from potential to reality, because it's reality we spend, and it's reality that will determine our fate. Potential will only determine our fantasies. So we've got to focus on reality. Thank you very much, Fumi. Thank you very much, our audience.
Thank you once again, Jimmy. Thank you so much. We're very grateful to all our participants for joining. We thank you for the interactive session. Thank you for all the comments, and thank you for the questions. I'm very sure we are all leaving here as better informed persons. At this point, we would like to just share with you what we do at Agusto Consulting. Agusto Consulting is a wholly owned subsidiary of Agusto & Co., the foremost rating agency in Nigeria, and we offer diverse range of services, including economic consulting, which speaks to all your macroeconomic needs. Something like this webinar we've just done, anything you'd like to understand on Nigerian economy and how it impacts your business. We also have business strategy and operations. We can assist you with your business strategy. We also have the people and organization services, where we conduct executive searches, remuneration surveys, board and even corporate governance evaluation. We have the Agusto Credit Risk Management Solutions, an application that helps banks and financial institutions to measure their risks appropriately. And then we also, offer a range of training services, from financial statement analysis, credit risk analysis, and as many more trainings as you may need in your organization. At this point, I'll hand over to Omolara to close the session. Thank you.
Thank you very much, Fumi. Thank you very much. Thank you very much, everyone. This has truly been an insightful session. Before we wrap up, my name is Omolara Okunowo, and I'm a Senior Business Development Officer at Agusto & Co. I'd like to take the final few minutes to briefly introduce you to Agusto & Co.'s research offerings and how we support organizations that we work with and organizations in general. At Agusto & Co., we're a Pan-African credit ratings agency and a leading provider of industry, sector, and macroeconomic research. Our work is centered on one key objective, and that is equipping decision makers with credible data-driven insights to support strategic investment decisions and risk management. In today's environment, where businesses are constantly navigating uncertainty, access to reliable intelligence is critical. And this is where our research comes in. Through our AI-powered Agusto Market Intelligence platform, we provide in-depth analysis across key sectors of the country, sectors including banking and financial services, insurance and pensions, oil and gas, energy, and a long list of industries. Our reports are designed to go beyond the data. They provide forward-looking insights to help to anticipate trends, sector-specific intelligence to guide investments and expansion decisions, risk analysis to support internal planning and strategy. Many of our clients, including financial institutions, corporate and development organizations, leverage on our research to identify emerging opportunities, strengthen internal decision-making, and to better understand the sectors that they operate in or are looking to operate in. Beyond our standard publications, we also offer bespoke client research. This allows us to work closely with organizations to deliver targeted insights tailored to your unique priorities. It could be evaluating a new market. It could also be assessing a sector or supporting a strategic initiative. I'll simply say that if you found today's session valuable, then our broader research offerings will be even more useful for your ongoing basis. We'll be happy to give you a quick demo of the AMI platform, share the few reports relevant to your sector, or just have a short conversation around your current opportunities and how we may be able to help you. So you can go ahead and reach us at marketing@agusto.com. I'll take that again, marketing@agusto.com. You can also stay connected and follow our social media platforms. Our LinkedIn platform is Agusto & Co. and Agusto Consulting. That's for LinkedIn. And for X, we have at Agusto & Co. and Agusto Consult, I beg your pardon. It's in the chat, so you can as well just look through it and then visit our social media platforms. Thank you very much. I'd like to say thank you once again for your time and participation today. We truly appreciate it, and we hope you found the session valuable. We look forward to continuing the conversation. Have a good afternoon, everyone. Thank you.
Bye-bye, everyone.